One of the questions always, hey, what do you think what's the max you think I can purchase? Anything real basic that we can kind of leave anybody with that's watching this that can, just run the numbers on their own, like right
Yeah.
now.
So without getting into specifics of rates and down payments, the key thing that we look at to see if you can afford a property is your debt to income ratio.
All right. So I'm Matt Hernandez on the Hernandez team right here in sunny Studio City. And we got a special guest with us, Ben Weisberg, Lend to America. Why don't you go ahead and just introduce yourself, give us a couple, tidbits of who you are, your background, things like that, Ben.
Definitely. Thanks for having me on, Matt. I'm Ben. I'm the manager, head honcho, basically, at Lend to America. We're a direct lender located, all throughout Southern California, mainly in the San Fernando Valley area. We span all the way from office locations in Westlake Village, the Conejo Valley, all the way through the San Fernando Valley and down to Orange County. And we work all throughout the state of California, Florida, and a couple others.
Oh, wow. I didn't know that about you guys. Okay, good.
Yeah.
Good.
Yeah.
So if you're joining us today, this is kind of our introduction to lending. If this is, your first time thinking about purchasing a home, we kind of got together kind of a small comprehensive list of some common questions that most first-time home buyers are asking, as well as some of the experience that you and I are kind of seeing in the marketplace right now, right?
Definitely. Yeah, it's a wild market we're seeing.
Right. So let's go ahead. Let's just dive into the first topic. I think one of the big things that I normally see is kind of like the rent versus own, conversation. Which one's better? Let's kind of let's just take a little deep dive into some of the pros and the cons with it.
Yeah, absolutely. There's definitely pros and cons to both. To jump right in, some pros of owning, I would say this is the biggest list of them all, is you can make changes to the home as you see fit. You're not counting on a landlord to, pick a paint color, pick what you want to do with the house. You can make it your own. And then more of the financial pieces, you're not dealing with yearly rental increases. In my experience, rent can go up, 5% a year, and that's big.
Right.
And then of course, with owning, you're investing in yourself. Owned homes appreciate in value. It's a real asset, it's real property. So you're gaining value the entire time you own it. Most of the time with real estate, we always say it's the best investment because it's always going to appreciate more than depreciate. I mean, it's very rare that property depreciates other than, some extenuating circumstances. Overall, things go up and down, but the curve goes up in the end. So you're really putting money back into your pocket rather than spending money, on rent and putting it into your landlord's pocket. You're paying their mortgage rather than your own.
Right. I'd like to kind of chime in a little bit on that one because you don't lose unless you sell, right? Because we did see the 2008 recession, and a lot of people lost their homes, a lot of people kept their homes, but until you sell the property, you didn't really lose, anything. You kind of weathered the storm, and the people that kind of fought through that recession are looking, on the other end right now, seeing, some of the biggest gains in the market that we've seen. But go ahead and, continue.
Yeah. To jump back in, some cons of owning, obviously there has to be something bad with it.
Right.
I would say the single biggest reason to avoid owning, which I don't think this is truly a reason to not own a home, is repair costs. Of course, you're going to have things that break that you're not going to be able to call your landlord up and be like, hey, this is your expense to fix it. It's going to come out of your own pocket. Of course, this can be prevented or at least significantly reduced with a home warranty and insurance. Of course, you're going to have property taxes. You're going to have an HOA if you're in that kind of a property. So those are more expenses. But in reality, when you're owning versus renting, if the place you're renting has HOA and they all have property taxes, you're paying that too, technically. And you might need more insurance when you own the property, but again, it pretty much all levels out.
Right.
And then to get into renting, of course, there's some pros to renting. It reduces your responsibility. You're not maintaining the property as much as you would in your own property. Liability goes down. The costs go down in terms of insurance, your liability,
right,
all that kind of stuff. But still, you're going to be paying about the same.
Yeah. What do you think at the end of the day, financial wise, like I remember seeing a study or, some statistics of the average net worth of an individual that owned a home versus the average individual of somebody who rented a home. And, financially, your net worth, owning a home at the end of the day, that person's net worth at the end of the day is, you're more valuable. You have an asset, you've been working, you've been paying it down. You could, pull some money out, buy a second home, buy an investment property. I just think that, renting, although it does have its advantages, like you said, you kind of having your arms behind your back and you're not, increasing your net value to be able to later on in life, open some doors to some possibilities that, you may never had when you're renting.
Yeah. I mean, the idea is traditionally your mortgage is 30 years. But if you rent for 30 years, after that 30 years, you're left with nothing. You got to keep renting. Right. If you own a property, you're paying your mortgage for 30 years. At the end of the 30 years, you're done paying. You're just paying your taxes and insurance then, and your utilities, which you'd be paying utilities too with renting. So you're doing yourself a huge disservice by renting long term. Right. Of course, it makes sense in certain situations, such as, if you're living somewhere short term, for instance, college, or, if you're moving somewhere only for 6 months or a year, it makes sense to rent short term. But for the long term, for your whole life plan, it makes a lot more sense to own. Okay.
Yeah. Cool. Well, let's kind of segue into my next point. A lot of, buyers that are especially new to the market that, I know I didn't really learn this when I was, coming into real estate and, as a young guy. I didn't know the difference between, someone like, you'll see the Rocket Mortgage and, direct lenders. I didn't really know the difference or what the pros and the cons were. They shine this, 2.99% in front of your face. You're like, wow, it gets you kind of thinking. Can you shed a little bit of light on, some of the things that someone new in the market may not, kind of understand?
For sure. So to use myself as an example in my company, we're a direct lender. So a direct lender means that we are the bank. When your loan funds, we're funding it. Title's going to show us as your lender. We're it. There's no middleman. There's not like some other parties that are involved. You don't have a bunch of hands in the pot. You have me and my team in-house that's handling everything. Okay. So being the biggest advantage is service level. Okay. You're working directly with us, with only us. We're available 24 hours a day versus, you go over to Bank of America or Wells Fargo or Rocket Mortgage, and it's going to all be over email. It's going to be 9 to 5. You're not going to get quick responses, and you're not going to get the assurances and the personal touch that we can give. Right. And you're not going to have that connection. I mean, for us, it's personal. We care about our clients. We have repeat clients. We know what's going on in their lives. I have a client right now that we are closing the same day that the wife is being induced into labor. You're not going to get the kind of service level with a big bank that they're going to make it happen on that same day for you. Right. That we will. Right. That's huge.
To kind of, to all, okay, being in my end in real estate, whenever I see an approval from Bank of America, from Chase, any big name, their lending department's going to be in Ohio and the other departments in Arizona. And sometimes there's big delays in that side talking to this side, and there's always a holiday. People, right now it's about 2-3 o'clock our time at the time of shooting this video. These guys are, they're gone on their way out, and good luck good luck getting them on Monday because they have a stack of files this big that they need to get to before yours. So I can definitely appreciate, I can definitely see that being a benefit to a buyer, especially in this market where we're seeing such low inventory, multiple offers on the table, that, if, let's say we need to lower our contingencies, or we need to lower our escrow period, that's, a team like you that's dedicated, local, can really, be attentive to the needs of the buyer and things like that. So
yeah, absolutely. That's a big thing that you brought up with contingencies, that we bring another benefit with appraisal. We actually have our own appraisal management company with our own staff of appraisers. So we have this relationship with some of the best appraisers, in the industry, that we can rely on, that they're going to get you the best results, the most true results. They know that, they know the area. They're not some appraiser that's coming from, Southern California to Northern California that's not familiar with the market. They're familiar. And being that they're our staff, we can get things turned around really quick. So if you need, a value check before you go into making an offer, you're getting a house is listed for $500,000, and with this crazy market, that you're going to be paying $550 for it. I can call up my appraiser before you even make the offer and say, hey, can you do a check on this house? Look at the pictures on Zillow. Beautiful. And tell me what you think it's worth. We're going to go in at $550, and they're going to say, yeah, it's good. I can make that happen. And then you can go in without a contingency.
That's amazing. That's amazing. And, especially for people, thinking about the market, having, the ability to call you and do a value check, or have me call you and do a value check, is something that's super, good to put you at edge, and as well as make you feel comfortable with your purchase, knowing that you may, you're not going to run into any value with appraisal or anything like that. What about some of like the rates that you see? You'll see like, some of these crazy rates that they can offer. Is that just kind of fluff? Is that something to kind of draw you in and, oh, sorry, you don't qualify for that, and then they give you the real current rate? Like, I see it, and
we all see it. One of my favorite things to do is when you see like a commercial, and not to name names, cough, cough, Rocket Mortgage. I like to pause those commercials and read the fine print. Okay. And they'll say like, when we know rates are in the 5% range right now, generally, and they're saying 2.5%, you pause it and it's like, okay, well, you have to have like an 820 credit score, which most people aren't going to have. It has to be, you have to be putting 50% down. You have to have no other debt. These qualifications that almost nobody is going to meet. Right. And it's these terrible loan programs. You're paying a bunch to get the rate. You're going to pay $25,000 just to buy a rate, which is ridiculous. Okay. So they're almost always just a way to get the phones ringing. Right. They're not going to follow through. Or they'll say like, oh yeah, we can get you 2.5%. And then right before you're going to close the loan, they're like, oops, sorry, we didn't lock you. It's now 5.5%. Oh man. And I can't tell you how many times I've seen that with bigger banks. And that's why people will leave those banks and come to us and say, it's not even about the rate at this point. It's it's about the trust. It's about the loyalty, the ethics of the process, that it's just not reasonable to do that to a client. Man, that's tough. I can only imagine to be the buyer, or even the agent position, to, get that call that, because you got to think that these purchases, it's one of the most stressful things that most people go through in their whole lives. Absolutely. So, for these things to happen, man, I can already imagine all the gray hairs that I would, all the gray hairs that I would get from it. Let's kind of, switch gears a little bit, and let's talk about some of the, the obstacles, some of the obstacles that you're seeing with, some of the current buyers, that are kind of coming in, inquiring about pre-qualificating or pre-qualifications and things like that. What are some obstacles? What are some things that maybe most people, they're not taking into consideration, or some things that they should take into consideration? Sure. Well, being the current market that we're in, we're seeing the highest prices in history. Inflation's just out of control. Homes are going way over asking. Rates are rising. This all goes kind of hand in hand, just to make a perfect scenario of something that's just terrible to deal with as a buyer. So yeah, rates are rising. Over the last 2 years during the pandemic, we saw the lowest rates in history, down to 2% or even the high 1% range. And everyone got used to these rates over 2 years thinking this is great. Everyone refinanced, everyone bought. They're like, we don't care about the price of the house because the rate is so low, it makes up for it.
Right.
And now that we're getting back into higher rates, quote unquote higher,
right.
We're in the 5% range, which that's where rates should be. Rates should be in the 4 to 6% range. That's normal. The 2%, low 3%, it's just not realistic and we can't maintain it. So it's an obstacle for buyers to get past the mindset that they should be at 2%. And thinking like, oh, I'm going to spend now an extra couple $100 a month just in interest. It's like, yeah, but that's normal. You're not going to go and open an investment account and you're not going to be like, oh, well, I'm okay with 1% return on my investment. You're going to want the 5%, and the banks are the same way.
So we were kind of just working on almost like borrowed time, like these were, they were great while they were here, but this is the rate we should have been. And the timing of it just kind of feels
I mean, and it really was just to keep the economy going while everybody was shut down for 2 years. And now that we're getting back to normal, we're kind of teetering that we're going to a little bit more of an extreme increase in rates, that we're getting to the mid 6% range even, but we're going to level out at some point in the next year back to the 5% range. We'll probably stabilize there is what we expect. But being with those, definitely some rate shock. And then, back to the rising prices with the higher rates. Now your down payment doesn't go as far. Your rate is going that much higher. Your home price is going that much higher. You might have 20% down a year ago, and now that 20% is now 10%.
Right.
It's the same dollar amount, but the percentage for what you're getting is a lot less. So that's definitely becoming an issue for buyers. And the big one is income type. So more and more, with the world of social media and more tech-based employment, we're getting unique income types. So it's not just, the W-2 normal borrower that's our bread and butter. It's easy to go through and easy to calculate their income. It's the self-employed borrowers that have multiple streams of income, that are doing their investments, they're investing in cryptocurrency and all these different things, that it's becoming more of an obstacle to document your income. So you might have the money to buy it, but it doesn't show on paper.
So kind of the new millennial money starting to come in, or the entrepreneurial people that aren't subscribing to the 9-to-5 job like our parents were, are starting to come in and become buyers. Interesting. Okay, I didn't really take that into consideration or know that that's kind of some things that you guys are seeing. So how are you guys working those type of clients that come in?
So it's bringing about a whole new range of loan options.
Okay.
So we're getting more programs where people have the money to buy it. They have their down payment, they have a ton of income, they know they can afford it and then some, but they don't show it on paper. So we're getting into programs like no documentation, no income loans, where you're going to have a higher rate, but you're not going to have to go through the nightmare or the impossible process of documenting income that you can't show.
Right.
This is for the people that just have a ton of money in the bank and either don't have income, or their income's just all over the place, or from wherever it may come from, they just can't document it and get a traditional loan. So we've got options for that now.
And the rate difference, between your bread and butter pay stubs, tax returns versus them, what type of rate difference are we kind of talking about here?
It's about 1 to 2.5% higher.
Really?
Rate, which isn't horrible when you think of the option as either not getting something at all versus buying a place.
Gotcha.
So and it always gives it. I always say taking the higher rate with an alternative loan program is just a great way to get you into a property. And then you start, for the next 2 years, you start showing your income on your tax returns for those 2 years. Then we can refinance you and get you into a more traditional type of loan.
Okay, gotcha. Well, okay, well that that kind of segues me a little bit into my next point, as far as like how do I get my, my finances or, in order to come see you? Like what does that look like?
So what I always say to a buyer that comes to me that says, I want to buy a house in 6 months. I say, okay, well, how much debt do you have? Do you have a high car payment? I see, it's a first time home buyer and they're driving around in a brand new Tesla with an $800 payment.
Right.
Okay. That's $800 now that you don't have to put towards your income or to show that you can qualify with. So what I always say is minimize your debt.
Okay.
I don't say get rid of all of your debt because it's not realistic usually, but if your debt's minimal, a couple credit cards, try to pay it off as much as you can, if not all the way. Because every dollar you have less in debt is more that you have to qualify with. So what I'll say, like, if somebody comes to me, I had an escrow a few months ago and they were 30 days out from closing. And he's like, the husband goes, oh, I have a Tesla on order. I'm really excited for it. The payment's going to be $950 a month. I'm like, okay, can you put it on hold? Mm-hmm. And he's like, yeah, I don't have to get it right now. I can take delivery of it in 2 months. I'm like, do that.
Okay.
Don't go out and make a big new purchase. Don't go out and take on new debt right before buying a home.
Okay.
Do it after.
And the current debt that you have, like, let's say I'm already, a year and a half into my Tesla payment or, my Tesla, and I have some student loans and I have some credit card debt. Is that all something that I should work, do you look at student loans?
Yeah, so we look at student loans and we look at it 2 ways. So we either take 1% or 0.5% of the balance of your student loan and use that as your monthly payment.
Okay.
Or we can get the original note from that student loan, which sometimes will be a lower payment, and we can use that payment against you. I know there's a lot of times where certain career paths with student loan debt will get forgiven, like medical student loan will get forgiven at a certain point. So you see like doctors in school that don't want to pay it off because they know it's going to just go away at some point. So we try to work around that and not have you pay it off. But if your student loan is $1,000 and you have $100 payment, I'd say, get rid of it if you can.
Okay.
Yeah. Same thing for a car payment. If it's a lease, we can't get rid of it. If it's an auto loan, we have some options depending on how much time is left or if you pay off the car. In certain cases with an auto lease, there is a workaround that we can sometimes finagle, and you can prepay the remainder of your lease payments to get rid of that monthly payment obligation.
Okay.
The issue is obviously you're forking out a big hunk of money to pay off the lease payments, and most people aren't going to have that, especially not a first-time buyer.
Okay, makes sense. Is this something that you will, kind of go over with your clients, as you're talking about, hey, look, these are some of the things that we see? Because I remember I was doing a loan, and I was trying to do like a cash out refi, just to kind of see or not a cash out. I was going to do a HELOC. Okay. And I remember I applied. There's not too many, people in the area doing it. And, I submitted everything and they just said no. Didn't give, didn't really like, hey, sorry, no, it doesn't work out. And I was like, well, is there something that, do I need to show more income? Like nothing. So is that kind of, I know I'm not saying that you do that. But
I was going to say, I've never heard of that.
That was my experience was, sorry, no, you got to, never got a call like, hey, this is what we're seeing, your income, ratios are a little off. If we can pay off this or pay that off, we could probably get you approved. Nothing. Yeah.
I mean, and that's going back to our service level that we're going to figure out how to get you a loan one way or another. And if I absolutely cannot get you to qualify for a loan, I'm going to tell you how you will in the future. I'm going to give you your credit report and say, okay, this is what you need to fix. Like, get rid of this collection, pay off this past due debt, pay this off, do whatever you need to do, show this kind of income, get your credit up this way, go to a credit repair agency. I'm going to give you some options that you can go and take it on yourself to make yourself more qualified to get a loan. I'm not going to just flat out be like, no, sorry, bye, have a nice day.
Is there anything that you're seeing that's like a common mistake or anything like that you can say, like, people are coming in and they're just not taking this into consideration, is, whether it be credit or their debt to income rate, is there anything that's just kind of like a recurring theme for you that you're seeing that, man, I don't think most people, number one, we don't get taught this in school. So is there anything that, off the top of your head that you kind of could give anybody watching a little nugget or anything like that, other than reducing your debt, and anything that kind of pops to your head?
Boosting your credit as much as possible.
Okay.
I don't say go and rely on Credit Karma, because that's going to take into account what if scenarios.
Okay.
So that's not a reliable source, but what you do want to have is established credit history. We have people that come in, first time buyers, especially, that, maybe they're 20 years old and they've only had one credit card for, a couple months, or maybe they don't have a credit card. They have nothing on their credit. That's what you call ghost credit.
Okay.
Where you might have a credit score, but you have no credit history.
Okay.
And with that, you can't lend on that because you have no, good faith in your credit history showing that you can repay things. So what I always say is, when you turn 18, get a credit card, get a secured credit card.
Mm-hmm.
Go to your credit union, wherever you do your normal banking, and say, hey, I want a secured card. And they have all sorts of options. And how they work is, you put down, let's say $1,000, just for easy numbers.
Mm-hmm.
You put $1,000 down, and your credit limit on that secured credit card is $1,000, because you are securing that debt with your own money. Mm-hmm. And after a certain amount of time of, using that card, paying it off in full, you're going to get that $1,000 back, and it's going to boost your credit. So basically, it's a way of ensuring that you don't spend more than you can repay, and you don't go into collections or have a late payment, because you have the money there securing it to prevent that from happening. So that's a great way to boost credit. Okay. And once you do that, go open up a regular credit card, keep, a small balance on it, pay it off in full every month, and do that, for at least a year or 2 years to make some good credit history. We like to usually see at least 3 credit trade lines on your credit history. So yeah, that's what I would suggest is one of the best things you can do to prepare.
Okay, beautiful. What about like determining affordability? Like I always see, one of the questions I always say, what do you think what's the max you think I can purchase? And
yeah,
that's a complicated question. Is there anything real basic that we can kind of leave anybody with that's watching this that can, just run the numbers on their own, like right now, after watching this?
So without getting into specifics of rates and down payments, the key thing that we look at to see if you can afford a property is your debt to income ratio, or your DTI, as we call it. So your DTI is the ratio of your total monthly gross income to your monthly debt obligations. So we always say your monthly debt total should be about 45% or less of your monthly gross income.
Okay.
And that debt being your mortgage payment, your taxes, insurance, your HOA and mortgage insurance if you have those, and your monthly debt such as car payment, credit card, student loans, things like that. We don't get involved in looking at your phone bill, your utilities, stuff like that, your gym membership. That's not part of your monthly debt obligations. Okay. So what I always say is, for example, let's say your gross income is $10,000 a month.
Okay.
And your monthly obligation or your monthly debt is $4,500. You're perfectly at a 45% debt to income ratio. So if you're at $10,000 a month of income gross, your monthly debt obligations total should be no more than $4,500.
Okay.
There are certain loans that we can go up to, 50 or 55% debt to income ratio, but we try not to get up there because you're not going to get as favorable of a loan. So just for rule of thumb, keep it under 45%.
Beautiful. Okay, perfect. Let's just talk about some, let's wrap it up. Let's kind of just talk about some down payment options. What are, some down payment options that most people have available to them, and then we can go ahead and just get ready to wrap this up.
Sure. Yeah. So different loan programs are going to have different down payment minimums. We have all sorts of options. Being with the crazy market and the increasing prices, we are bringing back no down payment, so $0 down. And then, you know, that's a specific kind of loan. It's harder to qualify for, but it is an option nonetheless. Our bread and butter is the traditional financing, you know, the 3 to 5% down minimums, or a 20% down, which in most cases, 20% down is the standard. And that's going to help you achieve the most favorable financing terms. Yeah, so you've got a ton of options in terms of down payment. There's different assistance programs. If you're a veteran, you can get no down payment. It's 100% financing, so that's a great option.
Yeah.
And then, of course, there's loan limits that vary by county. So you have to take into account what your down payment's going to be and what you can afford based on a loan limit. So Los Angeles County's high balance loan limit for a normal conventional loan is $970,800. So anything above this in LA County is considered a jumbo loan. And when you get into a jumbo loan, it's another loan program. You've got to have a higher down payment with a typically 10 to 15% down minimum.
Got you.
So, yeah, okay. It really varies based on the type of loan you're getting.
Got you. And you know, for everybody watching, these are percentages based on the end purchase price. So that's how you'll figure out, you know, how much down that you put is you'll take, you know, if you're looking for a $500,000 home, you know, you're looking at a 10%, you know, down. Yeah. That's how you'll get the numbers.
Exactly.
All right. Cool. Well, I think that's about it. I mean, anything else that you wanted to add to this?
Maybe one quick point is when we talk about down payment, we're not covering closing costs too. So closing costs estimate, you know, that's 1.5 to 2% of the purchase price, and that covers your escrow, title, and lender costs. So when you think, you know, 10% down, factor in another 1.5 to 2% of the purchase price into that as well
for your closing costs. And you know, let's also not forget there's a $500 appraisal fee.
Yeah.
And probably another $400 to $500 home inspection fee that we always recommend to every client. We never want to buy a home and never inspect it. So those are some additional costs. Ben, how can everybody watching, how can they get a hold of you?
So you can get a hold of me, either email lend@lendtoamerica, lend@lendtoamerica.com, or give me a call, 310-595-6736. Available to take your calls, texts, emails, voice recordings any time of the day.
Perfect. And you mentioned that you guys are licensed in California as well as Florida.
As well as Florida. Yep. Perfect. Working on a few others, so stay tuned for those.
Awesome. All right, guys. Well, that wraps up our video. Thank you so much, Ben. I think you had a lot of you know, insight to some, you know, common first-time home buyer and just, you know, some basic lending questions that come up pretty often. I really like to make this a series, so you know, our next video will be something, you know, another topic. Maybe we can get into whatever else that, you know, is pressing at the time. But that's gonna wrap up our video today, everybody. Thank you so much for watching, and we'll see you on the next one.
Thanks, Matt.
Later, Ben.
Bye.
Hey there, and if you're thinking about relocating to the LA and San Fernando Valley area, please feel free, shoot us a text, give us a call, send us an email, and we'd be more than happy to make that transition as easy as possible. Don't forget, hit the like button, subscribe, hit that notification bell, and we will see you on the next video. Bye, guys.